Understanding market cannibalization, an in-depth guide. Market cannibalization is a critical concept in business strategy, particularly for organizations involved in product development and marketing. It refers to a phenomenon where the introduction of a new product leads to a decline in sales of an existing product from the same company. This article explores the intricacies of market cannibalization, its implications, how it works, and strategies for prevention. What is market cannibalization? Simply put, market cannibalization occurs when a company's new product detracts sales from its own established products. This often happens when both products target the same demographic, leading to internal competition rather than capturing new customers or expanding market share. Key takeaways. Definition: market cannibalization is the loss of sales in an existing product due to the introduction of a new product from the same company. Impact: while sales might increase for the new product, overall growth may not be realized as it cannibalizes existing sales. Deliberate or unintentional: sometimes, companies intentionally cannibalize their products to outperform competitors, other times it results from a failure to reach new markets. How market cannibalization works. Market cannibalization typically hinges on emotional and psychological factors influencing consumer behavior. When a new product is launched, it may attract customers from existing products due to various factors such as innovation, features, or pricing strategies. Factors influencing cannibalization. Marketing campaigns. New advertising efforts can unexpectedly shift customer attention from one product to another, leading to sales losses in the original product line. Product similarity. If the new product resembles the existing one, the risk of cannibalization increases significantly, particularly if both compete for the same customer base. Store proximity. In retail environments, opening new locations near existing stores of the same brand can lead to direct sales competition. Investors and analysts often view cannibalization unfavorably. While it may boost short-term sales for new products, it can lead to diminished long-term profit margins, as companies may fail to maximize their market potential. Types of market cannibalization. Market cannibalization can manifest in various forms. 1. Planned cannibalization, common in technology sectors like smartphones, where new models are marketed alongside previous versions, intentionally reducing their sales to promote the latest product. 2. Discount-related cannibalization, when retailers routinely discount existing products, it can lead to customer expectations for lower prices, adversely affecting full-price sales. 3. E-commerce cannibalization. Traditional retailers shifting to online sales may witness a decrease in brick-and-mortar sales, although the new online channel can attract customers not previously part of their target base. Cannibalization rate. To assess the impact of market cannibalization, companies calculate the cannibalization rate, which is expressed as \text cannibalization rate equals 100 times \left frac \text lost sales on old product \text sales of new product \right. Preventing market cannibalization. While market cannibalization can be beneficial in certain contexts, businesses should adopt strategies to mitigate its adverse effects. Distinctive branding. By providing clear distinctions between product lines, companies can minimize the risk. This may involve varied pricing structures, branding strategies, and features to target diverse consumer segments. Careful timing. Companies must schedule product launches to avoid disrupting existing offerings. This can help maintain a balanced growth strategy across product categories. Market research. Thorough research and testing can inform how a new product will perform relative to existing products and whether it can successfully capture new customer segments rather than cannibalizing existing ones. Advantages and disadvantages of market cannibalization. Advantages. Innovation helps companies stay ahead by continuously innovating their product lines. Market share protection. Cannibalization can act as a protective measure against competitors seizing market share. Disadvantages. Brand undermining. Introducing low-cost alternatives can dilute brand value, particularly in luxury markets. Oversaturation. Risk of market saturation when too many similar products flood the same category, leading to internal competition and reduced sales. Real-world examples. Apple, the tech giant, consciously ignores the risks of market cannibalization. When releasing new iPhones, sales of older models typically decline. However, Apple expects that the new models will attract consumers away from competitors, thereby increasing its overall market share. Marriott, the hotel chain, launched a home rental business in response to Airbnb's rise in popularity. Though it cannibalized from its traditional hotel revenues, it aimed to capture market share from the emerging home-sharing segment. Conclusion. Market cannibalization remains a multifaceted challenge that can present both risks and opportunities for companies looking to innovate and grow. Recognizing the delicate balance between preserving existing product sales and pursuing new market avenues is crucial. By conducting thorough market research, employing distinctive branding strategies, and timing product releases wisely, businesses can navigate the complexities of market cannibalization while maximizing their overall growth potential. Understanding its dynamics equips companies with the tools they need to mitigate risks while leveraging the potential benefits associated with launching new products.